All right, good morning, everyone, and thank you so much for joining us for this fourth Koffee Klatch presented by Perkins Coie. My name is Matt Gilkerson. I'm the program manager for Trailhead Boise. We are a startup hub and entrepreneurial resource located in downtown Boise and have a variety of co-working and dedicated desk private office options, as well as a myriad of programmatic offerings, including Koffee Klatch. Koffee Klatch is a monthly talk where we are hosted by Trailhead and partnered with Perkins Coie. We have some awesome folks I'll introduce here shortly that have been here since the inception of this event. As I mentioned, this event is centered around helping startups, helping entrepreneurs navigate the legal environment, and ultimately helping them shrink the legal learning curve through a variety of ongoing topics throughout the year. Today, I'm really excited to talk about our topic centered around equity compensation. As you can see in front of you, these are a few of the questions we'll be answering today, as well as a handful of questions from the audience. One note on this is we do encourage the audience to ask questions throughout, including entering questions in the chat feature of this call, as well as when there's a question and answer time, you'll have the opportunity to ask both Derek, Melanie, and our guests today some questions. So with that, I'd like to jump right into introductions. First off, we have Melanie Rubocki. Melanie is the managing partner of Perkins Coie Boise, as well as on the Trailhead Board of Directors. So really excited to have Melanie here with us today. She also heads up Perkins Coie's business practice group for the Boise office and has a foundation in finance and entrepreneurial studies from the Wharton School of Business. Really excited to have Melanie here today. So welcome again. Also like to introduce Derek. Derek has advised startup, emerging growth, and privately held companies and venture capital funds on equity and debt financing, as well as other corporate transactions. Derek works with a myriad of businesses and contract types and range of industries and technologies, including food and beverage, consumer goods, and agriculture. Most importantly, a little biased, he regularly advises Trailhead. So thank you, Derek, and welcome, Melanie and Derek. And I would like to pass it off to y'all.
Thanks, Matt. Thanks for a great introduction, as always. Really, the true MVP today is going to be Miss Wendy Moore. So Derek, maybe give a little intro for Wendy, and maybe we can kick this show off right.
Yeah, by the looks of it, I think she's our chief political correspondent live at the Washington Monument this morning. So it's a pleasure to have someone with that capability here with us on the call. Now, Wendy is an expert. She is wonderful to work with. Melanie and I lean on Wendy constantly with our clients for all sorts of equity comp type of issues. And Wendy has been practicing law for over 2 decades now. She practiced, believe it or not, right? she practiced in our Silicon Valley office for a number of years and has made the move actually to the East Coast now, hence her background into Washington, D.C.
And not to age her, but she's a fellow Quake of the same vintage.
So Wendy brings just a wealth of experience and expertise to this topic, and so it was only fitting that that Melanie and I invite Wendy to join us for this and be able to answer your questions and just be such a valuable resource here in the Boise community. And if you talk with our clients who have worked with her, you will find that Wendy's just completely practical, right? Very easy to work with, and is able to just provide that resource that not only startups but large well-established companies need. So Wendy, thank you for being here. We really appreciate it.
Thanks guys for having me.
And Wendy, before we kick it off, I was going to say one thing I wanted to kind of just like to tee up the whole overall discussion is because I'd love for you to share this throughout the morning, Wendy, but people kind of pay short shrift to this area, and they use this area, equity comp, equity in the company, particularly with startups, you know, they tend to use equity like Pez in the beginning because they don't have money, right? And so they just like kind of spread it around, giving it away, not realizing that at the end of the day, we only have 100% of the company to give away. And there's a lot of pieces of this topic this morning that could be the wheels that come off the cart of the company later down the road. And, you know, when we work with startups, they're very focused on, you know, creating the product and the service and commercializing, you know, the company and getting it out there for everybody. And they're bringing people on throughout that process, and they're not always being thoughtful is not the right word, because I think they mean to be meaningful, you know what I mean? But they don't realize the pitfalls that surround giving pieces of the company away to folks. And it really seems to hit home here, because people get together, they create these relationships, and then within, you know, 3 months to 3 years, this may not be the right people on your team. And there's a lot of, you know, just things that surround, okay, but now this person owns, you know, stock in your company or options in your company. And so I have a feeling, Wendy, those will be a lot of things that we can, you know, not just the practicalities of, you know, an equity plan and what goes on in it, but truly the consequential impacts you've seen in your experience, because you do a lot of work with startups. So what do we got,
Yes.
Derek?
Yeah, no, I appreciate that. To kick it off, I mean, just, you know, at a very high level and piggybacking off what Melanie just said, you know, one of the questions asked is, you know, what are some of the common mistakes, right? And so, you know, in your years of experience in working with startups, you know, are there a few that just come to mind that are seem to be repetitive, right? That many startups are making?
Yes. So thank you guys so much. So as you noted, I started practice in 1998 at Wilson Sonsini as a summer associate, and spent my entire career up until last June in Palo Alto, working with about 400 startups each year. So I've seen a lot, you know, 3 boom and bust cycles. And when I work with clients, my job is to plan for the best, but also prepare the client for what could happen that goes wrong. I think a lot of times when founders, obviously as a founder, you guys are optimistic. You have a vision and you have a plan to execute, and the plan is to succeed. And I think it helps to take a beat and remember that there is a downside, and that this is your investment. And it's important when you are handing out equity compensation to think about what could go wrong and how to protect your investment in this. And that's, you know, everything from getting shares back from people you don't want to have those shares, to making sure that it's not just the percentage that you're getting out to the person that's the right number, but the terms and conditions associated with that percentage. So for instance, everyone, a lot of times people come and say, I need an offer letter, and I want to give this person 1%, 3%, whatever the number is. That's great, right? Number of shares is obviously key. Vesting schedule, I want to give, you know, 1-year cliff, 4-year vest, great, understandable. Where things start to get a little difficult is making sure that you understand all the terms and conditions associated with any promises of accelerated vesting. Do you need to sign a release to get the accelerated vesting? How do you define cause? What happens on death or disability? Is it appropriate to be giving this person severance vesting protections? Should the severance vesting protections only be on a change of control? Similarly, I spend these days about 40% of my practice representing executives, either coming into, leaving, or getting acquired at startups. And one of the things I like to talk with them about is making sure that they understand that they're getting the benefit of their bargain as well. That if they think they've negotiated this double trigger provision, that is, on a change of control, if I'm terminated within so many months after the change of control, I get accelerated vesting. Well, that requires that the acquirer actually assume the option. If that acquirer cancels the option for no consideration, you've got nothing to accelerate. So it's really thinking about how do all the terms and conditions of this option play out over the various alternatives, you know, change of control, IPO, staying private, liquidating, right? So making sure we've got all that covered. The other thing is, obviously we all hope and want these relationships with our service providers, our clients, our advisors, our employees to be positive. And in most cases they are. But there are sometimes people who leave and you're like, wow, I really wish they didn't hold that stock, either because they have access to your books and records as a shareholder, or because they get to vote on your parachute package when you as a founder sell your company and there's disclosures under the tax rules. And you're like, wow, I really wish that former employee that I fired wouldn't know exactly how much I'm getting in this deal. Or someone leaves and they compete or they use your confidential information and you're like, why should they get to keep my shares? They're hurting me. And so there are things that we can put in place in your stock plan or your award agreements that help protect you in all of these situations. And so it's really helpful before you start handing out equity to have these conversations with Melanie, Derek, or with me, or whoever your counsel is, to make sure that we're preparing you not just for the best outcomes, but for the unfortunate outcomes. And a lot of that is sometimes out of your control. So it's not just important to get the right percentage, but it's the terms and conditions of these awards that we should think about. I think another issue that comes up with equity awards, when I started, there weren't a lot of message boards or meetup groups for founders, right? And so it took a while for trends to move the needle in equity compensation. For my first decade of practice, there were no RSUs, which in hindsight, I can't believe. And yet now they're ubiquitous, right? Certainly at public companies and at many late stage private companies. And that's a result of a lot of, well, everyone else is doing it, I should do it too. And the thing is that what you see your friends doing in their startups, or what you've heard about other, really successful founders doing and saying that this was the key to our success, there's stages in your life cycle. And what may be right for a late stage company that's got a IPO in sight is probably not the right executive compensation device for someone at a series A or B, and certainly not the right device for someone who hasn't even gotten their seed financing. So it's really understanding that your equity program is going to change over time and understanding where along the way those pivots are. Mm-hmm. And that you just don't, well, everyone else is doing this thing, so I should be doing it too. One of the more recent ones I'm hearing is something that one of my colleagues called venture math. And it's using the preferred share price to determine a number of shares that are actually priced based on a 409A valuation. And I'm seeing that more and
Derek
more.
and I saw that in a deal we just did.
Yep.
I'll tell you, for the first 20 years of my practice, I had never seen that. And founders would have pushed back on that. Employees would have been irate. And I've had at least a dozen deals in the last 3 months where this is the case. And I'm just kind of surprised that venture math is catching on. I understand why it's catching on. In a way, I'm kind of surprised it didn't happen earlier, but it really reflects the shifting of the pendulum between founder rights, company and shareholder rights, and employee rights. And I suspect we're going to continue to see that pendulum go back and forth, right?
And what's interesting in the cases we've seen, it's the typical where the company doesn't even realize it's not good for them, right?
Right?
You know what I mean? And they're being convinced that this all makes sense, and next thing you know, almost 50% of the company's gone away in a round. That, you know what I mean?
Yeah. And so I think where all that comes out is whether you use Perkins or another law firm, before you sign a letter of intent, right? Before you send out an offer letter to someone who's getting a meaningful stake in your company, it's worth having a 15-minute conversation with your legal advisors to make sure you've thought of all of these issues and you're getting the benefit of your bargain and you're protecting your investment. Because I know you're working your tails off 24/7, 365 to make this company work. Let's make sure that you're maximizing your time and energy investment here. Other things that I see as mistakes, not getting proper board and stockholder approval, either of share reserve increases or actual grants. Making grants without setting the fair market value and just assuming that because you have a 409A that satisfies the tax and accounting requirements for making a grant. Making grants requires following procedures that are established by the IRS, the accountants, and corporate law. And so it's not just enough for you as a founder to be like, I have decided I'm going to grant Derek an option covering 100,000 shares. There's process that has to happen. And again, it's worth a 15-minute conversation with your lawyers to make sure that you're getting the process right. Because I will tell you that trying to fix this later on will probably cost $5,000 to $10,000, possibly $20,000 to unwind. So the $500.
Wendy, let's pull the thread on this one a little. There's a lot of things that you've been saying to pull the thread on, but as this one's always a challenging one because we run across companies all the time, particularly at the very early stage, right? And they just don't understand why we're encouraging them to go get a 409A, right? So on one hand, they're like, oh, let's just give common stock out. Let's do it at par value. Why can't we just do it at par value, right? And then they're separately in the market, you know, suggesting to potential investors that they're worth, you know, 5 million pre and something post. Talk to us a little bit about what happens to that slog of options that, you know, got issued miraculously, you know, a week or two prior to that.
Sure. So back in 2004, in the wake of WorldCom and Enron debacle, Congress came up with Code Section 409A in the tax code, and we got the final regulations in 2007 or 9, actually. Sorry, we got draft regulations in 2007. And what 409A says is that in order to avoid significantly adverse tax penalties to the recipients of these grants, that companies need to have a reasonable basis for determining the fair market value of the stock that they're selling to their employees. And they made it very clear that taking a percentage of the preferred round or picking something that you personally believe is the fair market value is not sufficient. And instead, what they've said is that you need to have a bona fide third-party valuation of this stock. And that means going to a valuation firm, whether it's Carta or Oxford Valuation or Armanino, and paying for this report. And again, Oxford and Solium provide, you know, free reports as part.
And by the way, Louise lawyers do not get kickbacks from this. We really wish we didn't have
nothing out of this.
We get nothing out of this. We really wish we didn't have to tell you to go get 409As. There's nothing in it for us. So
here's the thing. If you don't get it, there's a lot in it for us. And that's because
yeah, actually good business plan. We should probably tell people not to do it anymore. That'd probably be the smarter business plan for us lawyers.
So here's what happens. And I have a sample memo that Derek and Melanie, if you contact them, can hand out to you if you'd like. But what it says is under 409A, if it's determined that you've granted the stock at a discount to the fair market value, that is, the IRS believes that the stock is worth $1 or 10 cents even, and you've granted that option at a penny a share, right? Because your friend told you that, or your advisor told you you could grant it at a penny a share and you don't have any money, right? Here's the problem. Until that option is fully exercised or expires, as and when the share is subject to the option vest, your employee or consultant will have to pay withholding taxes and a 20% federal penalty. And for those of you employing people in California, there's an extra 5% California penalty. So this means, roughly speaking, for some people, a 75% tax bill. This 75% tax bill is on the entire spread each year of the option to the extent it's vested. So if I have 100 shares that vest in 2021, and the spread on those shares is $1, right? I haven't exercised it, but the difference between
I have no cash, I have no money to actually fund this tax bill.
Right. So my fair market value is $1 a share, according to 409A or the IRS. And my option was granted at a penny when it should have been granted at 10 cents. 99 cents of income that you haven't exercised, you certainly hasn't hit your bank account, is subject to the 75% tax rate. So your employee has to pay taxes on 99 cents of income that they've never seen. And by the way, you as the employer need to withhold that tax. So imagine having to go to your employees and be like, hey, I need you to write me a check for about 76 cents per share, even though you have an extra.
Employees tend to not receive that well.
And, and this, by the way, goes on and keeps getting higher and higher as more shares vest and as your fair market value goes up. It's mark-to-market taxation. So if in another year your shares are worth $2, you've got another $1 of income. Hey, employee, I need you to write me a check for 75 cents. And this goes on until the option expires. And by the way, if the stock price goes down, you don't get a refund, okay? So
Wouldn't that be nice?
I've had situations where people owe more tax than the stock is ever worth, okay? The other issue with this is you can't just be like, oops, mulligan, let's just increase the price, right? The IRS is 2 steps ahead of you. And they've created some really strict rules on how and when you can fix something like this. And the reality is it's very difficult to fix this after the year in which it's granted, and certainly after it's exercised. There's pretty much nothing you can do after it's exercised other than pay your employee a bonus to kind of make them whole. So the other issue is please, 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 if you are waiting for a 409A valuation and you're in the last quarter of the year, please don't make the grant without it, because if we cross into January, we may not be able to fix your problem for you. And even if we can, I guarantee you it's going to cost way more in legal fees than the amount you're saving your employee by this perceived discount off of what ultimately comes to be the 409A price. Now, I'm sure you're probably saying, well, wait a minute, Wendy, how does anyone ever find out about this? Right. So the obvious answer is the IRS audits the company or the IRS audits the employee. Now, we can't give audit risk here. We know that the current administration is looking for ways to fund infrastructure, among other things. And 409A is just a wide open field for penalty taxes that could be used. So there's that possibility. But more importantly, your investors and any acquirer is going to care.
Yeah, I would say, yeah, let's talk about the acquirer.
Yeah.
I'm glad I was waiting to mention that because not to steal your thunder on that, Wendy, but here's what happens, right? So no one's gotten caught, so to speak, right?
Mm-hmm.
And then they tell their friends, hey, I never had to get a valuation. Okay, but so now Big Co comes in and wants to acquire them, and they're diligencing. What happens, Wendy, whenever we can't backstop the 409A and the option grants over the last, I don't know, 3 years, 5 years?
Right. So one of my prior firms, I was doing about 40 M&A transactions a year on behalf of acquirers. The number one thing I had to do every time I sat down in the data room was make a chart. I'd take all the 409A valuations, I'd match them up to grants, and I'd see which ones had grants that were made on the eve of a 409A increase, or on the eve of the term sheet for a financing, or on the eve right as the term sheet for this deal is about to come through. And I highlight those for my corporate partners and my buyer client. And very often the buyer will come back and say, guess what? You've got to upprice those options, or else we are going to either make a special indemnity that takes away from the merger consideration. We're going to reduce the merger consideration, or we're going to report you to the IRS. And guess what? Once we're the buyer, we get to decide what the IRS knows. Okay. So the buyer has a significant amount of power to make your life miserable, your employees' lives miserable, and to take away gain from your investors, which will make your investors miserable. Okay. So this is probably the area I spend the most amount of time, whether I'm representing the company or the seller or the buyer, is trying to make sure that I've got a clean slate to defend all my option grants. And if not, trying to figure out how to fix it or mitigate the damage in the merger agreement. So this is really as much more in practice about making sure your buyer doesn't make everyone miserable as it is about following the law and not incurring the tax from the IRS audit.
And to add to that, Wendy, you see this not just in acquisitions too, but right, sophisticated investors want to know. So I had
First thing I do in diligence.
Yeah, exactly. I mean, we went through a series seed financing just in the past few months with a new client. We didn't handle their options, prior to the series seed financing. But as the investors sniffed around, they saw this, slew of grants that happened just as they were inking the term sheet for the series seed financing, right? And so it became an issue, and it's going to cost the company some money to get a new valuation, to fix those grants, et cetera. And so the exit scenario and acquisition, it definitely, comes into play. But even in these early stages, as you're working with investors to help fund your companies, particularly a sophisticated investor. Exactly.
Yeah, and there's a couple things you can do, right? I understand fully that you've made promises to people to grant them options. And at the time you made those promises, there was no financing in sight, right? And so these people joined your company thinking they were going to get penny stock. So there's a couple things we can do, right? One is you can go and get an interim valuation. You can go to your valuation firm and say, I'm about to sign this term sheet, or I've signed this term sheet. And your valuation firm can actually do a discount for the probability of that deal happening or not happening. And so what it does is it at least preserves some of the benefit of the pre-financing price. And so that's probably worth the $3,000 or whatever it is you have to pay. And again, $3,000 is pretty cheap, all things considered, if it's saving your employee $5,000, right, in exercise price. So that's one of the things I like to do.
Well,
As
Wendy,
you get more, yeah.
But Wendy, can't I just backdate it? I mean, I meant to give it to them a year ago. I mean, my board didn't meet. I can't really evidence that we properly approved it. So really 2 questions there. Why can't I just backdate it? And how important is it to have gotten the proper approvals? Because a lot of times we'll get that too, right? Like the CEO just wants to kind of give this stuff out and is like, I promised it to this person. Don't I have that power?
My job is to help keep you out of jail. And I don't say that lightly, actually. You can Google Broadcom and Greg Reyes. Now, back in 2007 or 8-ish, I was at Cooley. And this was when the SEC was cracking down, as was the IRS, on backdated options. And Broadcom, unfortunately, had a situation where it was accused of backdating options. And Mr. Reyes went to jail. He's a very respectable executive, right? And he was doing what everyone else was alleged to have been doing what everyone else was doing. This is something you can go to jail over, okay? Backdating doesn't work. I spent most of 2007 and 2008 trying to fix what I like to refer to as misstated options.
Misstated.
And that includes, say, granting the option as of the date the first person signs the board consent, not as of the date the last board member signs the board consent. So this is pretty serious. This can affect your accounting, this can derail your IPO, and this can put people in jail. So please take this very seriously. It's just not worth saving a couple cents on an exercise price when in fact, think about it. Think long-term, right? Equity is supposed to be about a long-term play. And if you're granting something at 5 cents or 10 cents, is it going to matter when your stock is worth $20 a share?
Yeah, it's a great point. So we have a few questions in the chat box. One's not quite related to anything we've chatted about, but we might. So we have one question, which is, what's the typical, I think they're saying end range of comp and equity for advisors and board members? So that's one question. And then the second question from Ernest relates, I think, to more what you were just talking about. What constraints, if any, do valuation firms have in looking at early stage companies?
2 great questions. And actually, the first one was something I wanted to get to.
Yeah, that's what I figured. We'd get there eventually, but it's been up for a while, so I thought I'd throw it out there.
So there are a couple resources that are relatively inexpensive for startups. So one of them is Advanced HR has an amazing database called Option Impact. And I know the woman who created this database from when I was a baby lawyer back in '99. And what she did back then was she went to all the venture capitalists on Sand Hill Road and she said, hey, how about you give me the data for all your portfolio companies, and then your portfolio companies can access my database for free. And so we at Perkins have access to that database. So for the cost of running the report for you, we can provide you with updated reports. The data is updated annually. There's even a little bar at the top of the graph that shows you how old each percentage of the data is. So like 60% of the data is only 3 months old, right? And it gives you base salary, target bonus, initial hire on equity grant, both as a dollar value and a percentage of the company, as well as follow-on grants. And it has that for executives, employees, advisors, and directors. And we can cut that by geography, industry, whether the person's a founder or not, how your revenue is, so we can compare you based on peers in revenue, employee size, stage of product development. It's a great product. If you're willing, you can contact Advanced HR on your own. And if you give your data to them, my understanding is you can access this database on your own for free. So it really is a great resource. Second to that one, Carta is rolling this out right now. It's a similar database based on every company who uses Carta for their stock plan. So Advanced HR is about 2,600 companies all over the US. Carta has, quite a few companies. The issue with Carta is it's like a $7,000 to $9,000 buy-in, but you are getting data from every Carta company. Again, I'm going to say we don't get anything out of this, but apparently if you sign up for Carta's program, unfortunately today, the last day of June, you get preferred pricing. You might, if you're interested in this and just can't take care of it today, you could probably follow up in a week or two, and we can give you the name of the person there to talk to. It's Francesca, but it's a great resource. And the reason I really like using data, my experience both representing companies and employees is I see that women and minorities ask for less, and they're offered less. Even when the executive is a minority or a woman. And having the benchmark data really helps provide an objective view as to what is appropriate for this range. And since we are seeing pressure to ensure internal pay equity based on race and gender and other criteria, using benchmark data can really help suss out unknown implicit bias that your hiring folks may have. It may help women and minorities who don't feel comfortable advocating for themselves or who have already suppressed wages from a prior employer be brought up to market. And it can help make the difference in you retaining or hiring these diverse candidates that can add to your business, right? We know that having diverse employees leads to more successful businesses. So use the data as your weapon to hire these amazingly diverse candidates. So I really do like data for that reason.
No, that sounds great. So then that's all good stuff, Wendy. Well, and frankly, a lot of people just don't know the ranges. And I think the other aspect of it, it's even just as simple as, a lot of times what we see with the startups is they have the, experts come in and impose upon them, oh, I know, I've done this, right? Like you're a founder, you don't really know what you're doing. I'm a fill in the blank, mentor. I know what I'm doing. And you just can't argue with objective data. Like objective data is the best way to go versus like, just not that people mean, like particularly with this question, advisors and board members, right? It's like, you got to remember whenever you're trying to incentivize these people, you are in a way adverse as well, right? So you want to create a relationship, but they're going to have their own interests that aren't necessarily aligned with what's best for the company in the long run. I don't think they mean to not do that, but if you're paying them, they're going to be advocating for themselves as well too. So it's hard to argue with objective data.
So you had a second question, which is
so Ernest asked the question about any constraints on valuation firms, and then we have a new question after that. But so his question is, what constraints, if any, do valuation firms have in looking at early stage companies?
So the AICPA is the guidelines that are required to be used for valuing companies for the purposes of 409A and stock-based compensation accounting. This guide is over 100 pages long. It has been around for decades. It is updated regularly and is led by, I believe it was at one point led by a woman from PwC. Again, 100 pages of guidance on how to do this valuation. It is very nuanced. It goes to whether you are a revenue generating company, whether you are so early stage that the way to value your company should be based on replacement cost. It looks at public company models. It looks at potential exit strategies. It looks at the current economic environment. Plenty of times I have companies say to me, Wendy, we've had such a hard year. There's no way our valuation went up. And I'm like, yeah, but the economy went like this, right? And so I've seen companies whose business has gone down and their 498 goes up simply by virtue of the economy getting better. 498 also has triggers or knobs and levers, including discount for lack of marketability and discount for lack of control. And so these valuation reports run 20, 30, 50 pages long, and they're looking at a significant amount of data. So anyone telling you that they can pull off a valuation in a day or two and they give you a piece of paper with a valuation and very little backup, you should be suspect of that. This is really an area where it's worth going to someone that is reputable and that your lawyers say that valuation is going to stand up to scrutiny by your investors and a buyer.
No, I think that's a really good point, particularly if you're already going to engage someone, you should engage someone that knows what they're doing in this area.
And to be clear, another thing that happens is someone gets a valuation and they don't like it, and so they go to someone else to get another valuation. You have to be very, if you're not liking what you're hearing from your valuation expert, definitely talk to your lawyer about what your alternatives are, because what we don't want to have happen is making a grant based on a valuation that can't be justified. And so having one valuation firm tell you that the value is $1, not liking it, getting another valuation that says 75 cents, the IRS is going to be skeptical about whether it's 75 cents or $1, right? And the way that the rule works is if you haven't satisfied the safe harbor for getting a good valuation, you have the burden of proof on audit of showing you got the valuation exactly right. Whereas if you have a good valuation that the IRS has to respect, they have the burden of proof of showing that your valuation was grossly unreasonable. I, for one, would rather make the IRS do the work than make you guys do the work.
Yeah, it's a good point.
Derek, I don't know how we're doing on our questions on our PowerPoint, because we have another question in the chat. So
I was going to say this next question, I think probably ties to the next slide a little bit, Matt, if you want to switch that. So in this next slide, there's a question that was submitted early on about, can limited liability companies issue options, or do they have to be a corporation? And I think it kind of, this question maybe ties into it of saying, hey, what are the flavors of equity comp? Are there really, and how much flexibility do we have? And David's question, was related to phantom stock plans, right? A little bit different, and said, how do they differ from actual stock awards, benefits, and scenarios where they might make sense, right? So it kind of plays into that. What are the flavors?
Great question. So I'm going to assume that your limited liability company is taxed as a partnership and not as a corporation. That's probably why you chose an LLC, right? Is to get the pass-through taxation benefits. Here's the issue. Limited liability companies can issue stock. Sometimes they issue units. But the problem is they are taxed very differently than stock in a corporation. They also have very different rights and preferences in terms of what you get on liquidation. And the more important thing is that if you actually issue a unit or a profits interest, and I'm going to put a pin in that for a moment, you are converting the person who receives that from an employee to a partner in terms of taxation of all of their compensation. So as a partner for tax purposes, that is, if I hold a unit in an LLC or I hold a profits interest in an LLC, my base salary is no longer salary. It's a guaranteed draw. And the company doesn't withhold on it anymore. I have to pay quarterly estimated taxes. Similarly, under the benefit plans, I'm no longer an employee. I probably have to pay both the employer and the employee's share of the premiums for my health insurance. And finally, I'm getting a K-1, not a W-2. And that may not be what your employees want to deal with come tax time each year. So think very carefully before promising equity in your LLC to your employees, this is definitely important that you have a conversation with your equity compensation specialist at your law firm to make sure you understand what you're getting and giving. The reason being is that a unit is like a full value share, and the person needs to pay for it. And that means paying the full fair market value for that share. And when they sell it, ultimately, that should result in long-term capital gain, much like when you buy a share of common stock. A profits interest is like an option in that you only share in the gain above the fair market value of the company on the date that that is issued to the person. But there's no purchase price for it, which actually is kind of nice because the person keeps it even when they leave, and they don't have to pay an exercise price or spread on the difference between the fair market value at grant and the fair market value when they finally leave the company. People do issue options on units. Again, one of the reasons they might do that is to avoid the person having to be treated as a partner rather than employee while they're in service. And they draft it such that the option can only be exercised on a termination of service when you no longer care whether they get a K-1 or a W-2. The problem being is that person's going to have to pay the exercise price for the share and the spread on the gain. And so much like a stock option, it can be very expensive to purchase. And then finally, there's phantom equity. Now, units and profits interests have the potential to yield capital gains. By contrast, a phantom interest is ordinary income. It's effectively a glorified cash bonus plan that pays out on a liquidity event. And the difficulty or the downside with that is that people are expecting capital gain, right? And so it's very important that you understand what you're offering and that your employees understand what they're offering. The other issue about phantom plans that's difficult is that it is subject to 409A in a different way than stock options. And depending on where you are in the company's life cycle, it could be difficult to grant phantom equity rights that allow the person to retain that right after they leave your service without imposing this horrible 20% penalty and 5% California penalty, right? And so this is something that you should undertake with your legal counsel to make sure that you are complying with the tax laws, that you and your employees understand the tax consequences of the phantom equity. But it is a viable alternative, and a lot of companies use it because they don't really want someone to have voting rights in the company or access to books and records. Now, the lovely thing about LLCs is you can actually create the same lack of voting right or lack of access to books and records with a unit and a profits interest. We just have to create a different class of units or profits interests. So this is a really complicated area that's kind of difficult to explain in 10 minutes on a conference call.
Well, I was gonna say, and David, sorry, Wendy, at the risk of interrupting you, for David's question, and David, you can fill in more if we're not being totally responsive, but I think depending on, I don't know if your question's coming from like an owner of a business or the recipient, right? Because Wendy, in our experience, a lot of times it's like, well, what are you trying to incentivize? What behavior are you trying to incentivize, right? Because if I'm an owner of a business and I've got folks that I want to kind of buy in, then I might be more inclined to want to do some kind of ownership thing. If it's really just a matter of not really, but like bonusing folks, and at the end of the day, these folks just want cash when you exit. You may want to pick different tools in your arsenal, and a phantom plan or something like that's perfect because it's not about ownership, it's not about titles, it's not about authority, it's just about somehow getting cash in people's pockets when there's an appreciation in the company. So there's a lot more that can go into the answer of those questions.
And then to answer another question that I know someone asked that's on our spreadsheet is, how are the new tax laws going to affect all of this? We just don't know. And so, a lot of thought can be put into, do I give someone an option? Do I give them restricted stock? Do I give them a profits interest? Do I give them a phantom interest? I think this is a year of uncertainty, particularly because the IRS has, and a number of Congress people have made it a concern about how LLC interests are taxed. You may have heard about the carried interest taxation rules. So plan for the best, plan for the worst, hope for the best, but really don't let the tax treatment drive what you are trying to achieve as the business goal. Is your goal retention? Is your goal letting someone work and move on to the next job and get the benefit of their labor? Is your goal to control ownership of the company? Or are you a very egalitarian owner and you want everyone to share and move on together? So really think about your business goals. And again, taking back to what I started with, how can this go wrong? And let's think through that before we commit.
I think that plays into the question, how do you determine how much equity an employee should receive, right? And you kind of touched on this already in terms of the objective data that's available. Analyzing your business plan, what is your goal with, is it attracting, is it retaining? And be mindful that that changes as your business evolves, right?
Yes, it
in
does.
the early
Derek,
phases.
and that's a really good point, because how many times do we see people wanting to apply the same principles early on, later on in their company, right? And how you treat employee 100, and by the way, I'm not putting a numerical value for any other reason than ease, right? But the person who started with you, regardless of their title, might have a different situation than the person you're hiring, down the road, who's, an employee.
Right.
Right. And it could also have to do with the skill of the person. A lot of times you're hiring someone as a startup and they may not be the most seasoned executives, right, that you could get a handle on. Whereas as you get closer to an exit, you may want someone with a lot of firepower who's done this rodeo 2 or 3 times, and that person may negotiate more. One of the reasons I really like the advanced HR data is on the report, you can actually see how compensation changes by enterprise value, right? On the one page, you can see that when enterprise value is 0 to 3 million, here's the appropriate grant. But when enterprise value is 500 million, here's the appropriate grant for that job, right? And so you can pre-plan and say, oh, over time with dilution, this is how that grant's going to play, how that grant is likely to play out. And that's why having that refresh data is also useful.
Yep. The last question on this slide, I don't know that it needs the remaining amount of our time. We have a few other questions we want to get to, but in terms of just the very high level, how are the options taxed when they're exercised?
Yeah, great question. And it depends on if the option is an incentive stock option or a non-statutory stock option. And for this one, I'm going to say that I drafted a memo that we have here at Perkins for clients, and Derek and Melanie can give that to you. And it gives the pros and cons of each of the different types of equity compensation awards: incentive stock options, non-statutory stock options, restricted stock, stock purchases, stock bonuses, RSUs, and it goes through the taxation of each of these types of equity awards. So getting that memo and really kind of marinating in the information and thinking through it, it's very user-friendly. I drafted in plain English so that it's approachable to someone who doesn't know, this is their first rodeo trying to figure out equity compensation. So I would refer you to Derek and Melanie for that memo, because it's definitely more than I can explain even in 15 minutes. I give entire hour-long sessions on this topic to clients for their employees. So if you ever get to the point where you want to have a session with your employees to explain what their options are, happy to do that for you. And I've got a whole slide deck that goes through the taxation with charts and everything.
Perfect. Yeah, I have requested the resource multiple times from Wendy, so I can definitely provide it. So the last slide that we have, and please, if there's other questions, before we get to the top of the hour here, if you have them, feel free to jump in or, chat in the box as a few of you have done already. Just in terms of vesting, so we've talked about some of the, logistical standpoints of, we have to have a plan, we have to, follow certain, rules when it comes to the SEC, when it comes to the IRS, et cetera. But there's a question that comes into play of, what is the intent of these options? What are we trying to use them for, right? And this concept of vesting comes into play, and many folks who've received options have experienced this, right? They get granted options, but they don't really have the right to exercise those options for a period of time. And so in our experience, there's a couple different types of vesting. Time vesting, you pay your dues, you stick around, the clock ticks, and so long as you're still employed or providing services, you're entitled to those options. But there's also a concept of performance vesting, right, where those options become yours as you meet certain milestones. Just in your experience with startups, maybe you could tell us a little bit about how you've seen these two different vesting strategies used, and offer any type of best practices guidance.
Yeah, so this goes back to what I was saying earlier with trends and shifting. And I will say a lot of times trends and shifting has to do as much with changes in the accounting or the legal rules applicable to stock options. When I started practicing, performance options were an anathema. And that was because they had really bad accounting treatment for companies that in a way that really could harm the company. And that freed up when FAS 123 and FAS 123R came around back in like 2002-ish. But even then, it didn't really change. Interestingly, in the last year or two, I've started to see performance vesting being used on options before companies are public. Part of this is that as companies mature and they're staying private a little bit longer, there was, it wasn't quite the heyday of the bubble where you founded your company and you were public in 3 years. And later stage investors, the D and E round, as you had unicorn status, were coming in and they were saying, well, we understand that the founders need additional incentive to get us to the next stage, but we're really concerned about dilution. And so the compromise seems to have been in what are called, and executives will tell me this when I'm representing them, they want a mega grant, right? And this is way more than is normal market compensation for a private company executive. But what it is it's pegged to performance vesting, such as a stock price achievement that the investors think is worth it to them to incur the dilution. Because the company's stock has to hit a certain price. The Elon Musk grant, right, where the stock had to reach $420, that's what we're talking about. And I'm seeing that more and more in these later stage unicorns for executive officers. And what I'm also seeing and recommending to my executives, even when we're not at that later stage, as a way to split the difference or in the higher on grant, a company will say, look, we can't grant you more than 100,000 shares or 3 million shares or whatever the number is. And my client's like, I'm not going to leave my old job for less than 200,000 shares or 5% of the company. And the way to split the difference is to have a grant, a base grant, based on what the company is willing to provide, and then have a performance vesting grant based on what it's going to take to get that executive or that key hire in the door. And so really, you're not giving up the dilution on those extra shares unless the company has this great, amazing result. And so I am starting to really like the performance vesting for private companies. But otherwise, what we're seeing in the last few years is variations on the 4-year, 1-year cliff model. And so part of that had to do with, and I can't remember if it was Bessemer or Benchmark, but one of the venture firms was trying to get companies to move to 5-year vesting and to do rear end, like backloaded vesting, where instead of vesting 25% in the first year, you're seeing 10% in the first year, 20 in the third, 30 in the 20 in the second, 30 in the third, and 40 in the fourth year, right? So you're making people want to stay with you for the long haul to get that giant bolus of vesting on the back end in the fourth year. And so that's been a really interesting switch from the standard of 4-year, 1 year. So again, it has to do with what's your business goal? How much dilution can you handle? Also, how sophisticated is your stock admin function? Having to measure performance vesting and making sure the milestones are getting hit. And gosh, please draft your performance conditions very clearly and think about how this could get misinterpreted later. I've seen ones where it talks about revenue, but then it doesn't talk about what should be added or subtracted from the calculation of revenue.
Yeah, so that's the big one we've seen, right? It's like they always want to tie it to revenue. It's like, okay, but what if the revenue, your company is failing? Like, you know what I mean? Like, okay, great, you got the revenue that came in, but if the cost of it was way more, like, should that person be getting, treated well?
Or EBITDA, right? Like what gets carved out, what gets added in. or even stock price. I've had stock price as performance vesting cause issues where people weren't clear as, does the 409A enterprise value count, or is it only the 409A per share price, or is it only the price on an exit, right? And then I've had situations where the board didn't like the valuation report that the company got from a valuation firm, and they were like, "You guys juiced that report, right? You gave them information that we disagree with. Go back and get a different report." So it really does. If you are going to go through performance vesting, this is one where you should be working carefully with your lawyers to make sure that you are being very clear and thinking through, how could this be misinterpreted later on? And are we really sure we've got this right? So,
and the one thing though I want to mention with performance vesting, because right now we're focused on, performance vesting, meaning like performance of the company, where it can work and you have to be equally articulate it well is, a lot of times what we'll see is with these early startups, they have the developer who comes in, and they'll tie it to time instead of performance, right? And then so you've got this, person who was creating IP that never actually creates the IP. And then you get into the issue of like, well, the person's been sitting around for a year or two, and now do they get their 10% of the company, but there's no product yet.
yeah, so my recommendation is stay away from 4-year vesting for people that you don't think you're going to need for 4 years, right? It's okay to give a consultant half as big of a grant with a 2-year vesting schedule. And please, if you're realizing, like, have a quarterly check-in, put something in your calendar to remind yourself, are all my consultants still working for me? And if not, send them a termination notice so that we can stop their vesting.
That's a great
the other
point,
thing people do
Wendy.
wrong, you have
That's
to
a great
tell
point.
whoever's managing your cap table when someone leaves, please. I've just had a client who for a year forgot to tell us that people left. And so people kept getting vested in Carta. It's very difficult to pull that back.
No, that's a great point though, because we had a client literally just a few weeks ago, same situation where we were tying numbers in the cap table and there was a bunch of rogue folks and they're like, oh, well, they're consultants. And we went and looked at their agreement and, we're like, well, where's the evidence that they've stopped vesting? Like where, did the agreement get terminated? Because of course the agreement was just open-ended, right? And they're like, oh, no, they stopped working for us a few months ago. Okay, well, where's the termination letter? How much stock do they think has vested for them? So it's a really good point.
Well, thank you guys so much for having me here today. I really appreciate it.
Well, like you said, Wendy, there's a font of information on this topic and just a lot of traps for the unwary.
Well, bring me back in 6 months and we can talk about something else too, or keep continuing this conversation.
I love it. I love it. Thank you so much, Wendy. And of course, Melanie and Derek for your time this morning. Real quick, wanted to throw out the next Koffee Klatch, which will be the last Wednesday in July, the 28th at 9 a.m. So in case you haven't noticed this theme, we're doing the last Wednesday of every month at 9 a.m. Mountain Time. This next month's will be focused around IP, intellectual property basics. So in the next 4 weeks, be thinking about those questions. And one last comment before I stop the recording is that anyone that registered for this session will get an email this week with a recording link to this. And also I do encourage anyone on this call to please provide me any feedback and or follow-up questions based on today's topics and or questions that are related to the IP for next month's. So with that, I just like to, again, thank you so much, Wendy, for taking the time to join us this morning. And as well as Melanie and Derek, thank you so much.
Thank you, Matt.
Thank you.
Thanks, everyone.